In this analysis, we're not just going to talk about a crisis, we're going to transform it. We're taking the raw data, the institutional research from the 2026 Hormuz crisis, and we're forging it into an actionable, high-convection portfolio strategy. Let's dive in. Imagine that headline flashing across your screen. In a heartbeat, Brent crude oil blows past $100 a barrel. Now, this isn't just a news alert. It's the trigger for one of the biggest macroeconomic shocks we've seen since the 1970s. So here's what we're going to do. We're going to map out the catalyst, expose the investment traps that caught so many people off guard, and then, most importantly, we're going to lay out the institutional playbook for how to play the fallout. Okay, first things first. Before you can even think about where to put your money, you have to get your head around the sheer scale of this disruption. This isn't just some regional flare-up. It's a crisis at a vital global choke point, and it sends shockwaves through the entire financial system. Let's break down the numbers. It all kicks off right here, February 28th, 2026. The shooting starts with Operation Epic Fury. Just a few days later, on March 4th, we see the response. Iran's Islamic Revolutionary Guard Corps shuts down the Strait of Hormuz to all commercial ships. And just like that, bam, the global economy slams into a brick wall. And that shutdown, it translates to this monster number, 20%. That's the percentage of the entire world's petroleum consumption that is now trapped, unable to get where it's going. In an instant, the world loses a fifth of its daily oil supply. To put that in raw numbers, we're talking about 20 million barrels of oil per day now stuck. Imagine an entire fleet of supertankers just idling at sea with absolutely nowhere to go. The physical supply chain is fundamentally broken. Now, here's where it gets really interesting. Look at how the market prices this kind of risk. For any tanker that might even think about making the journey, the war risk insurance premium just explodes to $5 million. That's for a single voyage on a standard $100 million tanker. That cost alone is enough to freeze global trade right in its tracks. So with the physical supply completely paralyzed, what happens to the price? Well, this is how we get to what the big institutions started calling the $150 oil scenario. The market's knee-jerk reaction sent Brent screaming past $126. But for the pros, the real worry wasn't just the spike. It was how long it would last. Bank of America was warning of $130 oil if the blockade continued. Oxford Economics was modeling a scenario at $140. And Wood Mackenzie's worst-case scenario? A jaw-dropping $150 to $200 per barrel. The key takeaway here isn't just the price, but the duration. Now, during a war, what's the first retail instinct? Flee to safety, right? Well, this is where the first major trap appeared. The market's reaction was completely counterintuitive, and it created what we call the safe haven paradox. If you blindly bought gold in early March, you lost money. Why? Just look at this comparison. Gold, the classic safe haven, went negative. The US dollar, on the other hand, soared. This tells you everything you need to know. In a true crisis, investors don't just want safety, they want cash. They want liquidity, and they sold their most liquid assets, like gold ETFs or paper gold, to get it. And this was the mechanism that drove the whole thing, the margin call. As stock markets were plummeting, institutional traders got hit with these demands for more cash. And to raise that cash fast, they had to sell what they could, not what they wanted to. And you know what's first on the chopping block? Liquid assets like gold. So how did the sophisticated investors play this? They followed guidance just like this, from UBS. They understood that the dip in gold wasn't some fundamental failure. It was a temporary liquidity event. The playbook was clear. Use that dip as an entry point for physical gold, and then broaden your commodity holdings into industrial metals like copper and aluminum, which have their own deep structural supply problems. All right, let's tackle the second major investment trap that sprung up from the crisis, that instinctive, almost knee-jerk rush into defense stocks. It seems logical, but the institutional data told a very, very different story. This table contrasts the two approaches perfectly. The retail instinct was simple. War is good for defense companies, so buy the ETF. But the institutions saw huge red flags. A forward price-to-earnings multiple of 39 is historically just way off. But more importantly, they saw the risk of government scrutiny pressuring these companies to invest in production instead of share buybacks, which would seriously squeeze shareholder returns. So, we've navigated the traps. Now let's get to the actionable strategy. This is the institutional playbook for generating alpha during the crisis. And believe me, this is where the real opportunities lie. The core thesis is summed up perfectly in this quote from Mizuho. Forget the crowded, risky trades. The real, high-conviction opportunity is in energy companies that are completely insulated from all the chaos in the Middle East. So what does insulated actually look like? It looks like top-tier North American exploration and production companies with deep inventory and zero geopolitical risk from this specific conflict. We're talking about names like ConocoPhillips, Coterra, and Permian Resources. And you can't forget the oilfield services sector, where a company like TechnipFMC showed massive momentum. When you put it all together, a sample crisis portfolio would look something like this. The core holding is in those insulated energy equities. You layer that with a strategic position in physical gold that you bought on the dip, and then you round it out with broader exposure to other structurally strained commodities like copper. And one final crucial warning from the institutional side. While direct commodity funds like USO saw huge inflows, analysts from firms like Morningstar are clear. Trying to perfectly time the absolute tops and bottoms of a volatile market using these kinds of leveraged instruments is an incredibly dangerous game. And that really brings us to the final question this crisis forces every single investor to ask. After seeing how institutions navigate the chaos, you have to look at your own strategy. Is your portfolio truly positioned for risk, or is it inadvertently built on it?